Yeah.
We okay?
You ready?
Yeah. 3, 2, 1, go.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome to the Alt Goes Mainstream Going Public series with Glenn Schorr. In this special series, we aim to make private markets more public. We take a deep dive into the public side of the alternative asset management industry. Our guide, Glenn Schorr, is a well-known Wall Street analyst who has covered alternative asset managers since the first firms in the industry have gone public. Glenn is a senior managing director and senior research analyst at Evercore ISI. Glenn has covered the financial sector since 2000 as a senior analyst and has consistently been named to Institutional Investors All-America Research Team for his coverage of brokers, asset managers, and exchanges and large-cap banks, most recently ranking number 2 and runner-up respectively in the sectors in 2023 and number 1 and number 2 in 2022. Listen in as Glenn shares market stories, the evolution of alternative asset managers as businesses, the biggest and most exciting trends in private markets based on what the industry's largest players are doing, and we also will go around the horn for his analysis on each of the publicly traded firms. I couldn't ask for anyone better to take us on this journey. Glenn and I hope you enjoy.
We're going mainstream.
Here we are, going public, live from Evercore, huh?
All right.
I see you got a Monster energy drink over there. It's been a rough couple of weeks with earnings.
Been a rough couple of weeks, yes.
Why?
Well, it's kind of ironic that these amazing secular growth businesses that invest over decades in the private markets can get whipped around by, some important small changes in the market. So their stocks can move like this, even though they invest for 10 years at a time. So yeah, we went from euphoria to a lot of fear in a couple weeks. I think they were just okay earnings, but the sell-off wasn't just because you had high-priced stocks with okay earnings. I think it was more of a function of the reason why the stocks had such good runs is the anticipation of a pickup in deal activity, M&A, IPO, that would lead to monetizations, that would lead to more fundraising, wash, rinse, repeat, and lead to lots of growth. Now, a lot of that's still going to happen. Most of that's still going to happen. But we got pushed back on our heels again because the unknown and uncertainty of the implications of tariffs and taxes and Fed policy and geopolitical issues that are going on right now says, hurry up and wait. Let's digest this. And what you thought was going to be a first half story, maybe it'll be a second half story. And then maybe, there's a little fear that it might be a next year story. And we've lived this. This is the third year in a row of we're having this conversation. So unfortunately, quick moves in stocks that should be much longer.
Are you getting this sense from the firms that you know and cover and have talked with that they are thinking that things will be pushed back or exits may not happen in the same time frame?
Sure. I've met with some of the management teams of the alternative managers, some of the big banks and brokers management teams, all in the last handful of days. Sure, some stuff needs digestion, and some stuff will take, quote, a few months when you were hoping it was starting now. That's the stuff that relates to M&A and IPO and pieces of the private equity and private real estate market. But, I remind you, last I checked, these stocks had pretty good 2023s and amazing 2024s. Last I checked, there wasn't that much M&A and IPO going on. There's a lot of other stuff. Charles Barkley talks about the others being the important parts of winning games. Well, the others have been important parts of these companies growing.
How much of the others can these managers control versus can they not control?
Well, you control a lot over the long term and you control almost nothing over the short term, as we are seeing, right? But if you look at the secular trends of more of the lending markets moving into the private markets, infrastructure in these tremendous total addressable markets being invested in, the growth in penetration in Asia, in the wealth channel. Like these can be controlled, and they are investing into it, and they're growing with or without M&A taking place, is my point.
When you bring up some really good points, right? Like infrastructure, it's a few $1 trillion of AUM, but feels like a lot of people are underinvested. That there's trillions of dollars that need to go into all sorts of infrastructure, whether it's data centers, decarbonization, digitalization, et cetera. Private credit, another one, right? Alternative credit. That's a multi-trillion-dollar market. I think Blue Owl has it as 11 trillion. Real estate. So all these markets are massive. I want to separate the forest from the trees. So first, alternatives managers, they've obviously seen a pullback. Is that because they are overvalued, or like then thinking about the forest long term, there's all these big trends. They're going to raise lots of capital. They're going to work with the wealth channel. How do you balance those two things? Like, are they valued right today, or were people thinking about where they were going in the forward to be thinking about them in the current valuation framework?
I would say that's the hardest part of my and investors' jobs every day, is to figure out what's in the stock, what's not. As I mentioned, you had a great 23 and 24, and some of that was anticipation of what's to come. And so if you pull the rug out, as the market just did, you get a correction. The valuations were high, but at that valuation just a few weeks ago and the current valuation now, I don't think people think KKR or Blackstone is a different company worth more or less. The stock market says it. It's kind of the irony. It's kind of the topic of private versus public investing. Just because the stock price went down 25%, is the company truly worth 25% less than what it was, right? Theoretical question. So look, I'm going to oversimplify things. All these companies, when they put out their investor days and they have their 5-year targets, I'll oversimplify things and say, most of them say, we think we're going to double, private equity will grow this, credit will grow that, infrastructure. But it usually comes up somewhere around we can double every 5 years or so, and that's about a 15% CAGR. Do I think they can still double? Absolutely. And the irony again is sometimes it's heads they win and tails they win, because it stinks when the market pulls back, it stinks when your stock goes down, it stinks when the value of what you own is something worth less today because the market went down. But some of the best investing periods for this industry has come in market wipeouts. I mean, I remember not so far ago that in March, exactly 5 years ago, March of 2020, when COVID kicked in and the public markets went down 33%, and these companies invested tens of billions of dollars into the market, and those created some great investing opportunities, and that's the whole point of the model.
So you balance that, which is generally that's more carry-related earnings, performance-related earnings, versus fundraising, which generally is what drives fee-related earnings, management fee-related earnings. Do you think that in a more uncertain market like we're in today, and we don't know how long that will last or how it will unfold, but do you think that managers will have more trouble raising capital going forward? We also have a backdrop of there's been less distributions, particularly in private equity. People are waiting for liquidity, all of those things. So what you're saying, I think, makes sense in the context of their carry or performance-related earnings could benefit in the future if now is a good time to invest. But will they raise the same amount of capital going forward?
I'm going to answer the question exactly the way I asked it. Will they raise the same amount in 2025 than you thought just 4 weeks ago? Probably not. Probably less. Just because there will be some people in some strategies that take a step back. Private equity is probably high on that list because you wanted the monetization engine to kick in such that you return cash, such that you can go into the next vintage. But I do think the perpetual products are at this early stage in the wealth channel. They're going to raise probably more. I think there will be opportunistic funds that come across. I think there will be the growth in Asia is probably unaffected, and Europe's market is doing a lot better. Like these are, and infrastructure, I will take the over on everyone's predictions. Asset-backed finance and the insurance channel, like there are opportunities here that are outside of the volatility. But net, to answer your question, yeah, probably less, and it's one of the many things that the stock market's reacting to.
So then, which managers are best positioned to handle this? Is it the managers with all sorts of brands. I wrote about this recently, this concept of super alts firms, where there's one prevailing view that being a multi-manager, multi-strategy platform, the question is, can you be the best at everything? That's what some people think. The benefit of being a multi-strategy or multi-product platform is that you have the benefit of scale in many regards. So who is at an advantage in a market like today, and who's maybe at a disadvantage if they're more indexed towards a certain asset class or strategy?
So I love this topic, and yes, I read it. I read everything you do. So look, when I 30 years ago started on the sell side researching the traditional asset managers, this was a foreign concept because if an institution ran an RFP that was going to do a search for a small cap manager, they would look at all the best small cap equity managers. They'd run a process, they'd do some finals, they'd run an RFP, and then they'd pick 1, 2, 3, whatever it is of the best ones, and they'd allocate money. And then that would fit in that style box. And then when they want to go do a large cap value, they would do the same process. And it was a product by product performance and process win one at a time. And so over time, you would hear companies talk about solutions and bringing a set of solutions to clients and helping them with their outcomes. And so there's room for both in the world. There's still product by product, picks best manager, and then there is a trend that you're seeing now also in the alternative space of big firms delivering a set of solutions, and you can't do that unless you actually have a set of solutions. So I do think there will be times where, say, let's make believe infrastructure was hoovering up all the money raised in the space and getting all the attention. Sure, someone that has a humongous infrastructure business will be great in that area. But product preferences and style trends and market conditions change, asset allocations change over longer periods of time. And I do believe a broader set of solutions is the answer to your question to smooth cycles and to be able to be a super alt, to be able to deliver a set of solutions. And you know what I found in history? You don't have to be top decile performer in every single asset class and every asset product to deliver that set of solutions. You could be top quartile and have a good, consistent process. And there are some managers that come to mind that have, even to this day, are excellent in the traditional asset manager world, and they were never top decile. They were just always in the top half and top quartile and consistent, and that helped their client feel safe delivering a broader set.
It gets to the question of brand, right? How important is brand in that context? And doubling down on building a great brand, is that what enables firms to be these super alt platforms in a sense?
I'm going to answer yes, but I'm going to clarify the obvious. How you get that brand is not just advertising. You earn that through blood, sweat, and tears every day over the last couple of decades to show consistent performance across many metrics in each asset class that you attempt to compete in, right? So, and then the way you service that client, the way you educate them, the way you hold their hand, the way you help them get to their solutions or their outcomes that they need. Yes, that all goes into that brand and the relationships you build. So I say yes to the brand, but it's so deep, it's so many layers to it.
The other interesting thing about that is we're seeing managers, particularly the largest ones, really try to find the spots where they don't necessarily have capabilities or solutions or want to augment them. Apollo and Bridge is one recent example that comes to mind. What do you make of something like that acquisition?
It underscores the conversation we're having right now. I would say if the world continues down this path in private credit insurance and direct origination and then spreads into asset-backed finance and then large private investment grade opportunities in the private markets, Apollo is amazingly well positioned. Probably the best position out of everyone in the space if those trends continue the way they feel. And I think they will. The knock I would have said the day before that is they could have a bigger real estate franchise. They could have a bigger infrastructure franchise. Guess which two areas they just made acquisitions in, right? So I do think we are at this moment in time where both the buyers and the sellers, or the bigger and the smaller, are coming to what do I want to be when I grow up conversations. And by the way, not everybody has to be big, broad, and in everything. You could stick with your knitting. I always talk about my neighbor Mike in my marketing meetings. Neighbor Mike is a senior partner at an amazing transportation and logistics private equity firm. They have a young partner base. They might choose to go that route for the next 20 years. Or they could raise GP stakes money, or they could sell to someone to be part of something bigger if they want to access the wealth channel. Like, these are decisions that are different for each firm. I think there are a lot of 10 and 20 and 30 billion AUM companies that might want to be part of something bigger, that might think we're not big enough and it's too late to start building a wealth franchise if I want to penetrate that channel, or I want to be able to smooth cycles and I want to be part of something broader. And that's why you saw Apollo make 2 deals recently. Blue Owl did 4 in a matter of 8 months last year. BlackRock put down $24 billion to get into infrastructure and private credit in a bigger way. You're seeing a lot of it, and I think it underscores your super alt mindset.
So one other trend we're seeing right now is there's competition between the alternatives managers and banks, particularly in areas like private credit. There's also co-opetition, maybe frenemies to some extent. What are you seeing happen from banks in that context as they look at all these alternative managers getting into private credit?
I love the subject because I cover all the big banks, the big brokers, the traditional asset managers, the alternative managers. They are all so important to each other. They all compete with each other. They all distribute each other's products. Like, they share deals. They compete for some equity deal, and if one doesn't win it and this one does, they say, oh, can I help you finance that? Like, it is all of the above, and it's been that way my whole career, and I don't think private credit, we'll use that as an example, is any different. Let's start with the basics. The high yield and levered loan market and broadly syndicated loans, if you were a high yield company, if you were a levered company that, maybe you could issue bonds, but probably not. You had to borrow from a bank and a syndicate of banks, and that's the way life was. And one bank would arrange it, and then they'd syndicate it out to lots of other buyers. And that has good and bad things that go with it. Over time, the direct lending market started to come into play, where I talked about the number of public equity companies has been cut in half, and the number of private equity-backed companies is up 4 or 5-fold. And they started borrowing from direct lenders in the private market, and that's taken a third to half of that space. And so that's well known, well documented, and now borrowers have that choice of just another lender in the market, and sometimes it's the cheapest and most available capital at a bank, or the bond market, or the private market. So now there's more of the trend towards some parts of asset-backed finance that's been dominated by the banks in the past, which is a total addressable market that might be anywhere from 3 to 7 times larger than that market, depending on whose guesstimates you go to. Some of that's transitioning over, and because the lenders, the people themselves, some of them would rather work at an alternative manager than at a bank. And then some of the alternative managers have bought or grown their own direct origination platforms. Some of them own insurance companies, so they can cut out the middleman and originate and put it in there and have a higher yielding product for the end LP or end insurance person, so annuity holder, whatever. So some of that's transition. And so the banks aren't just going to sit around. And by the way, let's hard stop there before I get to what the banks do. But remember, the largest fee-paying clients to the banks on the planet Earth, by a long shot, are the private markets firms. And so they already have an amazing relationship, whether it be investor, structure, lender,
Distributing their product.
distributor, product, any of the above. They're all so important to each other. In credit land, the banks aren't just going to sit back and be like, oh, that's nice, they're eating my lunch every day, and I guess I can't make those loans. They had no choice in parts of the hot non-investment grade market. As more of the investment grade starts to move over and gets more structured, more complex, or at minimum just gets funded by something in the private markets, the banks will have to react to that too. Right now, they lend to the lenders, but some of this is about capital charges and some of this is about ability to compete. JP Morgan met with them last week. They put out a press release that said we've now fulfilled our commitment of $10 billion of private credit loans in the direct lending market, and we're going to up that to $50 billion off our balance sheet plus another 15 from our partners. And you're like, that's awesome. That's they have 32,000 middle market borrowing clients, and so some of them are going to borrow in private, and they want to say, we can speak for that loan. We could put it on our balance sheet. We could syndicate it out to our private credit partners. We can do what some of them, they can do. And in some cases, that's exactly right. And in some cases, like maybe the Meta loan, maybe that it can't afford to write a $34 billion check and speak for that whole loan. And maybe that's why one of the private credit managers has been named in the press to be on that.
What do you make of this announcement by JP Morgan? Because last year there were talks about them buying a private credit manager. Monroe Capital was the one in the news, a $19 billion firm focused on direct lending. Didn't happen. Wells Fargo has spent more time in the private credit space trying to think about how do we originate. We have great origination capabilities because we're in the middle market. We work with a lot of small businesses or medium-sized businesses. We can partner with a private credit firm. How do you think about how banks are thinking about moving the different chess pieces they have on the board?
Well, they have good chess pieces because they have a lot, like I mentioned, JP Morgan has 32,000 middle market borrowing clients. That's a lot of chess pieces. Make no mistake about it, a bank wants to deliver agnostic, full advice for their client. And in the past, if you could say, hey, I could do a broadly syndicated loan and help you arrange that and then syndicate it out, or I can help you in the bond market. And they're like, hey, what about a private credit loan? And they're like, well, we don't have a private credit manager. I could talk to them and I can arrange them. What they've done is they've solidified through their own capabilities and some big important partners, each one of them in different ways, and said, we want to deliver unbiased, purely agnostic, great advice to our client, and then execute whichever path is best for them. I believe that 100%. Some will do it better than others. Some are way ahead of others. I think JP Morgan has made tremendous advances over the last couple months. Now, one last thing I'll turn back to you is, let's just keep in the right perspective. They just announced that they completed doing $10 billion of direct loans to 100 different transactions over the last 3.5 years. Last I checked, Apollo did Intel, that was $11 billion in one transaction. So there's some big chunky ones that maybe the big banks can't do. Maybe the big banks are really just catching up and trying to fill that out. They'll compete against each other and they'll partner with each other also.
When I hear what you just said, though, that makes me wonder, why wouldn't banks just look to acquire private credit firms or have those capabilities in-house? Some banks do, right? Goldman has that.
Some banks do, and it's very hard, and they will continue to try. So Bank of America sold their Malim asset management business a very long time ago and are not going back into it. JP Morgan is an amazing asset manager that could probably use some more private credit capabilities. And let's say they wanted to. Okay. Raise your hand if you're an awesome private credit manager and you want to go sell to the big, scary JP Morgan. Like, that's not for everybody. They might find some, but I understand HPS selling to BlackRock. I understand Atalaya selling to Blue Owl. If we could re-roll the tape and say, I can get you the same, or hell, I can get you a better price from JP Morgan right now. Do you want to keep selling? Because you get engulfed into this big franchise. So selling is a big decision. To whom you sell to is an even bigger one.
But if you're a $20, $30, $40 billion manager, credit space, what moves are left on the dance card, right? Like, you have to then compete against the Apollos, Blue Owls, et ceteras of the world. If you're not going to end up consolidating into them, how many more HPSs are there in the market? Like, where do you go? And how do you get advantages when it comes to things like origination, which a bank has?
Well, first of all, there have been partnerships formed, right? Citi and Apollo is one that comes to mind. Citi said, we could probably use more, but we have a couple of things going on right now with the government. Maybe we should focus on that. Let's have a partnership. They agreed to a $25 billion of outsourcing over the next 5 years in direct origination loans. That helps them stay originator, stay good advisor to their client, and have Apollo be the storage business. And that's what they want. It's a beautiful partnership. That's the route they chose. For whatever reason, they chose not to buy, or there was nothing to buy, or whatever. But each situation could be very unique. There's going to be some that are all of the above. I'm sure there's probably no exclusivity in there. And it doesn't mean if Citi got there, together one of these days and actually had a currency that they could get into the acquisition game. But I think top level is more asset classes are moving from just public market financing, and some are doing more in the private, and you got to adapt to that.
Where my mind goes with that, you said something that illuminates all of that, which is the moving and storage business. Some firms are in the moving business, some firms are in the storage business, and that gets to duration, and duration either mismatch or duration matching.
Yeah, and mind you, every loan a bank makes is a longer duration than their overnight deposits. But that can be managed, and the balance sheet can be managed. And I think these private direct loans, that's just another loan on some level. Some probably come with different capital charges. So it's not apples to apples. There is still regulatory arbitrage and capital markets arbitrage and duration of deposit arbitrage. And let's not forget, if a bank makes a loan and syndicates it out, there are a lot of seats at the table if anything needs to get renegotiated or restructured over time. And if Apollo or Blue Owl is your direct lender, you might have a different type of workout relationship and be on the same page. And that's to each his own from a borrower standpoint. And that's what's changing over time, is certain borrowers are preferencing the flexibility that comes along in private markets.
So maybe this is a moment in time where markets are a little bit tougher for alts managers, but part of the draw of these firms being able to add to their platform is they have a public stock currency that was trading very well. Now it's trading a little bit less well. Do you think this current moment in time and environment impacts the larger firms from a strategic perspective in terms of trying to buy firms now because their stock price has gone down a bit, or does that not, for the long term, really impact?
I don't want to call it nothing, but it doesn't impact the long term. The stocks go up and down, and the market eventually comes to equilibrium and realizes value, and great companies do great and poor companies do poor. Over time, it goes like this, takes time to react. But it is an interesting observation within your question that every one of those deals I mentioned were all stock deals. Okay. Now, there is a difference in currency and in multiple of the public managers, or if you're going to take a GP stakes and private. Now, there should be. One is giving up full control, and one has no control. One is 10, 15, 20% of growth capital for GP stakes for various reasons. And one is, I give you my baby, and please be good with my baby. So there are different multiples, and I like that my companies have been buying things with their stock, not because they had overpriced stocks, but I want the seller to take the same stock and help march down the same path. And by the way, it's the same stock that they ask public investing shareholders to take. So I like the alignment of it all. I like when you have a good currency to use it. And yeah, if it just took a 25% hickey in the last couple of weeks, yes, that impacts things. But the world is kind of simple also. They give you X percent. The value of whatever they're buying is probably down a little bit in the last couple of weeks also.
Yeah, I mean, it brings up an interesting framework when thinking about this too, right? Like these smaller managers trade at a certain price, certain multiple. The larger managers are trading were trading at a certain multiple. Now maybe that's a little bit lower. But adding these firms immediately often becomes accretive because you add a smaller firm, but that can raise capital. You look at some of the acquisitions that have happened over the last year. These are firms that can raise capital. Go back even further, right? Look at Oak Street. Look at how much Oak Street has raised within Blue Owl's real assets platform.
Almost a
right?
triple in 3.5 years.
And think about what that does from an accretive perspective for the business. So these are interesting things to think about it when thinking about them from the perspective of, it's not all math, there's a cultural element, but from a math equation.
That's correct. And historically, people business, there are not tons of examples in history in the traditional asset manager world of acquisitions that were amazingly successful. There are some. And then there are a bunch that were less than amazingly successful. So sure, there's the theoretical integration risk and transition risk of founding partners transitioning to the next generation. That is all yet to play out in this space. The interesting thing you bring up Blue Owl is I and plenty of others saw, you wake up every other month and to another deal, you're like, well, how can you execute on all this? And the answer is, well, you're not integrating it. You're not changing the investment staff. And they are buying into spaces that they weren't in. And those management teams that ran those businesses now have a seat at the table, at your table. That's the benefit of white space and filling in. It's more interesting, right? BlackRock bought big behemoth companies and putting onto a platform where they had some presence. That will come with a little more heavy lift, but also, as we saw this week, some heavy benefits. I mean, last I checked, they just did a $22 billion port deal this week, including the Panama Canal, that may or may not have happened for either one of them if they weren't together as a combined entity. So there are some big benefits and some execution risk.
You bring up a really important point, which is the benefit of scale and having a broader platform. There's arguably no place that's more apparent than that being a benefit for these managers who get consolidated into the bigger platforms than in the wealth channel. Because think of what they can do when they have a dedicated platform, distribution team, marketing team, resources, ability to manufacture and create evergreen funds. You need the scale and capabilities to do that. Is there anything that you're seeing with all of these managers as they continue to penetrate into the wealth channel that's notable from past quarter?
First, I'm going to make a quick comment on scale, then we'll talk wealth. I love the topic. Again, growing up as a student of the asset management industry, there were some strategies where scale was always eventually a weight around your neck, where it limited your ability to put up alpha and generate returns, and therefore growth. And what's interesting is there are many cases in private markets right now where scale is a huge beneficiary. You looked at it I'll give a couple examples. When GE needed to get out of the real estate business and they needed to sell this 30-something billion dollar portfolio, they made one phone call. Hello, Blackstone? Boom, done, right? To be able to speak for large checks and large transactions is a big benefit. In the GP stakes business, Dial has by far the largest funds, and if there's a big established manager that wants a 10 or 15 or 20% check, we're talking $1 billion, $2 billion. You can't write $2 billion check out of a $4 billion fund. It has to be something bigger, right? This week, I mentioned the $22 billion port deal. I mean, there's a couple of firms that could write that check. Blackstone, I saw a news story, was doing like a $5+ billion secondaries trade for a New York City pension plan. Like, there are so few competitors in that big ticket space. And same thing in private credit for like Apollo. I think there was a news story last week, Friday of last week, that Meta wants to do a $34-35 billion financing of their data facilities. Like, notice there wasn't a bank named on that deal. That is long-term, locked up, big balance sheet capital.
Apollo, KKR.
Correct.
And even those firms, as big as they are, they couldn't do it necessarily on their own. But that does speak to the scale aspect, which is an important thing to note, which is, in your view, there are parts of private markets where scale, or strategies where scale really does matter. Do you think investors understand that as well, where it's like, okay, these actually might be categories or asset classes where I would want to invest with the biggest manager because scale actually helps?
So I think the big LPs absolutely know it, and that's why they keep giving them more and more money. So that there's proof positive of that. When you say investors, I'm assuming you also assume public market investors. Look, I think the people that have been investing in this space for a while know these companies really, really well. And so I say yes to them. However, what's shocking is even with all the years of growth and us and me and my peers telling the story and the success of the stocks, it's still amazing how many public investors still don't invest in these stocks. And that's so encouraging for me as an analyst covering the group to say, okay, KKR has been in the S&P for over a year and Blackstone over 2 years and Apollo for 6 or 8 months, whatever it's been. And yet a huge percentage of the largest funds still own 0 shares. That's encouraging to me because it's a process.
Why are many of these mutual funds either I don't necessarily want to say underinvested because maybe they have reasons for why they're not invested in these managers, but why do you think there is still underinvestment in these alternatives managers from a lot of these funds?
Some of it is indexation, and if you're not in, you're not in, and therefore I have my blinders on and I can't have strategy drift or whatever. Some of it is education and understanding and familiarity, and these are complex companies to cover, buy or sell side. They are complex to understand, and as we've seen, sometimes reasonably volatile, high beta stocks, and you have to, and then some of it is strategies. There are some huge funds that are value plays that might not call Blackstone or KKR a value stock. So some of it is growth and income funds that these tend to, generate capital over time and don't pay out high income anymore. There's a bunch of different reasons, but some of it is just literally needs time. I and my peers have been working at it for a dozen years, and a dozen years from today, everyone's gonna, finally get the joke.
What will it take for those firms to start understanding that, short of all these firms being included in the index or something like that?
Look, success, you hate these things at 10 times earnings when they're this big, but when they triple in size and trade at 25 times, you love them. Like sometimes the success is there, but think about this. Wealth channel penetration goes from nothing to all of a sudden your FA is calling you and saying, hey, have you looked at this, this, and this, right? The familiarity back to your brand. And then how many more deals you need to see, whether it be the port deal or all these data facilities that Microsoft and every hyperscaler is investing tons of money in, and 0 of them are being financed by some regional bank. It's being financed by the private credit markets as the asset-backed finance market transitions over. Like, how many more signs do you need to see before you start investing and they start being your surrogate financial play?
You're already leading me to my next question, which many of these firms have said they are going to grow AUM significantly, particularly in the wealth channel. So to your last point, is this inevitable?
I think investing, being a sell or buy side or investing in public markets is so hard. You're so humbling. You're wrong so much. I think there are very few what I call fat pitches. I used to be a baseball player. There are very few fat pitches in the world. This has been and continues to be a fat pitch. It is inevitable. 90% or so of companies are private. The number of public companies in the United States has gone down in half in the last 20 years. Number of private equity-backed companies is up 4 or 5-fold. They can finance themselves in the private markets better than ever before. They're staying private longer when they need to. Infrastructure, investable market, the TAMs are, I don't even understand them. They're so big. They're 40 trillion for infrastructure and 20 trillion for the power that you need to, the data centers. The numbers are huge, and the world is understanding that banks are great, but they do have overnight deposits, sometimes really overnight with a tweet, overnight deposits with a maturity mismatch of the asset and liability. They're making loans longer than the duration of their deposits, and then we do that on 10 times leverage. That's why we need regulation to make sure that that doesn't get off the skis. And over here, you have these really long-term markets being financed with long-term liabilities with less leverage. and sometimes no leverage. Seems like a better way to go about it. And so, yeah, more of the market's going to be financed in private.
That makes sense in terms of how you match duration. The question, though, becomes, what then becomes the risk if more capital flows to these private markets managers? Is there the same risk? I think people would say with banks clear and able to understand what that risk is when you think about duration mismatch. What is the risk then with alternatives managers as they get more capital?
So I'm going to leave off the risk that people care about in the stock market is competition, which there's a lot of, brings a lot of capital, which whittles down returns, which makes it not what it was supposed to be, and then fees follow, and then the stocks do poorly. That's a risk for the stock over a long period of time. That's what happened in the traditional asset management market. And a decade from now, hopefully, we'll have this discussion, and it'll probably be there. But that's not the risk you're referring to. The risk you're referring to, I think, is there's less transparency here. There's no oversight, or there's less oversight in the regulator. The insurance businesses have oversight. The 40 Act funds have oversight, right? Like people say, there's no oversight. There's less, but it's more importantly, there's less transparency. But the reality is, if you have longer duration capital and you have time and you have diversified portfolios and great investors making long-term decisions, there's less risk there, in my humble opinion, because time does help you cure some wounds. And Blackstone and others talk about this thematic investing. Think about this. The market was just doing great, and it was euphoria, and then all of a sudden it's like, wait, tariffs, and the market goes down. What the market's going to do today or this week or this month is so hard, it's unbelievable. That's the hardest job in the world. You give me a suitcase of money and say, I'll see you in 10 years, that's not as hard. You can see long-term trends like we talked about, data and infrastructure, like the need for data warehouses, the power to facilitate the infrastructure investments that are being made, like the transition of certain things into the private markets. Like, if you could have money for a long time and not have to get mark to market every day and have the wherewithal to invest for the future, like, that's a better way to invest. And that's why all these LPs give them money.
Well, the interesting thing of where my head goes, and I'm a private markets investor, not a public markets investor, but it makes me think, and also appreciating the nuance of public markets, but imagine if people thought about a private markets framework to investing in the public stocks of these publicly traded alternatives managers. What if you thought about them over 10-year time horizons and just said, yes, there'll be volatility up and down, but to our point earlier, the long-term trend of growth of raising money, growth as a business, like, what if people thought about these firms as private markets-like investments, just that happen to be in public markets?
So great, they should, but it's a circular reference here. They don't. Why? Because most of the time we're talking about them in wrappers with overnight funds for deposits. So if you stick it in a mutual fund and say, hey, listen, private markets are going to double in the next 5 years, just buy this stock and own it for 5 years. Great. And then they saw what happened this month, and then the value of the investments are going down, and some people, like many hedge funds for risk management purposes at the top level, had to degross. Many momentum investors ran out, right? And some individuals might have sold. So again, that's one of the beauties of this business is what does a good FA do for their client? What does a good private markets player do for their client? They take some of the short-term emotion out of their hands by not transacting in good or bad times. 5 years ago today, in March of 2020, I was way scared about the world, and the market went down 33%. And I am sure some people sold a lot of stock or redeemed mutual funds or did whatever because they said, I don't want my money to go down anymore. Well, if you had long-term locked up capital and you have 15 or 20% of your money in dry powder, this industry plowed tens of billions of dollars into the market as soon as it could because they said, these are the opportunities that we get to invest. So great investors go against the tide, take duration and emotion out of the equation. They should buy them. I don't know what KKR is doing in the next month. This is weird times in the market and unpredictable. And I am confident in their 5-year plan to double everything. So what are you supposed to do? You're supposed to buy it.
So going against the tide, what is your going against the tide view right now?
Yeah, going against the tide is what I just said. The world just sold these stocks and others, right? They're not the only stocks that went down. But I and lots of other people was very confident in the 5-year plans in this space in November. And now everything's 20-25% off. You don't like a nice 20-25% off sale? Like, it doesn't feel that way. They're going down again today probably, but going against the grain is you're supposed to start allocating money in just the way they are. Last I checked with my eye test, these companies are deploying their dry powder into this market.
Are there any firms that are more at risk to some of the geopolitical impacts, the economic policy impacts, tariffs that make them maybe more susceptible? Is it something in credit? Is it something in real estate? Is it something in private equity or infrastructure where some managers may actually have more troubles than others going forward if things were to persist?
It's a really good question that has so many levels to it that I'm not sure I'm going to do a great job. I'm going to try. I saw an interview yesterday with John Gray of Blackstone. He was asked a similar-ish question. And his answer was, we don't invest in many companies that are, importing goods into the United States that are about to go through this. But I do think, as we saw during COVID and other times, supply chains haven't all moved in. Everybody's just not a directly vertically integrated channel. And so there will be some challenges, and the stock market has been trying to express that. I think the biggest issue is uncertainty makes people do this, right? You sit on your hands, you sit back and relax. And so these companies thrive on activity. Sometimes sitting back is good for them because when others are selling, that's when they start getting interested in buying. And like I mentioned, these companies have, some of them 17, 18% of their AUM in cash right now to deploy on behalf of their LPs when they see value. And so, weak-handed sellers sometimes bring good spoils to those that have some cash in a shoebox.
So I think that brings us to next question. I'll preface it by saying when you and your son, Brian, were in London the other month, you were interviewed outside of an English football match. You were asked a bunch of questions. Who would you start? Who would you sit? Who would you swap? You're a Man City supporter, so sorry for everything this year. But it sounds like you would swap a lot of players for the Arsenal players. But you like basketball too, so we'll go with the starting five. So who's your starting five right now?
Starting five right now. Okay, I'm gonna answer it. I'm gonna answer in it's March. It's March Madness in the markets. It's March Madness almost for stocks. Who do I think is going to be in the Final Four?
Okay, sure. We can do Final Four.
Thing?
Let's do it.
Same thing? Okay. The Final Four, I do believe big, broad, diversified managers have scale benefits now and have scale benefits in the future. Half your life is centered around the wealth opportunity in private markets. I could not agree more. Well, if you haven't already built out that channel, in the famous words of one of the gatekeepers of the biggest wealth managers, what children are you hiring to try to start your wealth distribution platform? And the servicing that goes on involved with that. If you haven't been in Asia for the last decade or two, you could start to grow, but you're going to need a bunch of time. If you don't have a big, broad, proven infrastructure platform, how are you going to get the port deal that just got announced for $22 billion? If you haven't built data warehouses already, what hyperscaler is going to say, go ahead, build me your first one. Let me know how that goes. It's only my whole future, right? So I believe in scale and breadth. And so my Final Four as we sit here now would be, in no particular order, KKR, Apollo, Blackstone, and Blue Owl.
All right. Well, March Madness. Get your brackets out, right?
There you go.
Let's see what people
Let's
have in their
go,
Final
Vandy.
Four. Good luck on that one.
Yeah.
Awesome. Well, this was great.
All right.
Ton
Awesome.
of fun on going public.
Right. Later.
Yeah. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going mainstream.